We are going to be looking at simple moving averages in this lesson. We briefly mentioned this technical indicator in our last video, and here we'll dig a little deeper into what it is, how it's calculated, and its uses.
Yes, I remember you mentioned this indicator.
And what do you remember?
Well, I believe it's a lagging indicator rather than a leading indicator. Is that right?
That's good. It lags the price, which means it's looking back and it is there to confirm to us if something has happened. A moving average is a trend following indicator. This means we can use it in a few ways to help us determine the direction of the trend.
That's up, down or sideways, isn't it?
Yes, the moving average smooths price action over a predefined period of time, and from it we can work out where the trend is.
Could you explain that one again, please?
Sure. To put it simply, a moving average is the average of the closing price data for the periods under analysis. From the current time frame, as we move into a new period, the oldest period's data falls out of the calculation.
I think I'm following, but can you clarify what you mean by current time frame?
Well, say we are looking at the moving average for 10 periods. If I'm looking at an hourly chart, then it's looking at the last 10 hours. A moving average on daily chart would show the last 10 days and so on. We set how many periods we want the moving average to be for. We'll look at why this is important in a minute. There are several ways of calculating a moving average. We are going to look at two of them. First, it's a simple moving average. Here is a formula for calculating a simple moving average. With all the indicators I'm going to introduce, I think it is important to go over the formulas and provide a worked example in a spreadsheet you can download from the materials section. By doing that, you'll be able to better understand what it is that you are looking at and the importance of the settings. However, in practice, your charting package will calculate all these for you.
Interesting. So I presume that price 1, price 2 and so on are all the closing prices we're looking at. What does the N stand for in the calculation?
N is the number of periods we've set the SMA to. This is specified by the trader.
Ah, okay, understood.
Let's take a look at a quick example with a 5-period simple moving average in a daily time frame. Let's say the closing prices for the last 5 days are 10 on Monday, 12 on Tuesday, 13 on Wednesday, 9 on Thursday, and 11 on Friday. We would add them up to get 55 and divide by 5 to get 11. Our 5-period simple moving average is 11.
Got it. That's fairly easy to follow.
Yes, it's not too complicated. This calculation is performed for every period, plotted on the price chart and then joined together to form a line.
Okay, so now that we know the formula, how is it affected by price changes?
Throughout our introduction to the various types of indicator, I'll show you how each indicator reacts to price changes. For moving averages, let's look at our example again. Let's say we move forward a day and the closing price has leapt to 25. We would lose last Monday's price of 10 out of the calculation and include the 25. This means that our data set is now 12, 13, 9, 11 and 25.
Yes, I'm with you so far.
Add these up and divide by 5 and that gives us a simple moving average of 14.
Okay, I've got it.
Good. Think about what happened here. Our price has increased by 14 from Friday to Monday, but the moving average has increased only by 3. from 11 to 14. This is smoothing. Moving averages smooth out the price action, which we then use in several ways to help establish the direction of the trend.
So, am I correct in thinking that the more periods we use, the smoother the indicator will be?
Yes, that's right. If we had been using more periods to calculate it, say 50, then each individual period's price would contribute less, 1/50th towards the moving average. Next up, we are going to look at how to add a simple moving average on a chart. Moving averages provide traders with more information when they're plotted against the price of the security that's being analyzed. I want to show you how to set one up on a chart.
Sounds good.
So, here we have a daily chart for the UK 100. To add a moving average, we select Studies from the top menu, scroll down and find Moving Average.
Crikey, there's a lot of indicators in here.
Yes, there is a fair few. There are hundreds of different formulaic ways to analyze a market, and each indicator tells us something different. The key is how we interpret what they tell us.
Okay, understood.
So let's set the parameters. If we set a 20-period moving average, we want to use the closing price and not the open, high, low, or any other combination. So the offset lets you move the plotted data back or forward. But don't worry about this or the underlay. Now you have a 20-period simple moving average line on your chart. This is the moving average for each period plotted and joined up with a red line.
That was pretty easy.
Yes, it's not too difficult once you've seen it being done. You can see the smoothing effect it has on price.
Yes, here the price is all over the place, but the moving average is slowly tracking down.
Great, you can see how when a trend develops, like here, a moving average will lag the price. In essence, it takes longer to track the trend. So now that you know how to add a simple moving average on a chart, let's take a quick look at one of the things you need to watch out for with simple moving averages.
Okay, so what are the limitations of simple moving averages?
Well, we'll get into some of the wider limitations of moving averages in general in the next video, but the point to note here is a simple moving average weighs each data point equally. But in practice, do you think yesterday's price is as important as a month ago?
I'd say not, no. It seems logical to give the more recent prices more relevance in our analysis. Sounds a bit problematic.
It can be. That's why analysts developed the exponential moving average, which we'll look at in our next video.